In Chapter 13, we continue our discussion of a company's capital structure. And we talk about what happens if a company restructures their capital structure or is trying to find an optimal capital structure. So the optimal capital structure is one that maximizes the value of our cash flows. This is often called the firm's target capital structure as well. So we have the capital structure is the percent of debt and equity used to fund our assets. Leverage is the term for the amount of debt we use in our capital structure. Capital restructuring is changing the amount of leverage without changing the firm's assets. So in a restructuring situation, we would issue debt to purchase outstanding shares, or to increase our leverage, or issue new shares to retire outstanding debt in an effort to decrease our leverage. The primary goal of financial managers is to maximize stockholder wealth. If we maximize shareholder wealth, that maximizes our firm value and minimizes our weighted average cost of capital. We want to choose whatever capital structure that will minimize our weighted average cost of capital and maximize our stockholder wealth. So what is the effect on financial leverage? Financial leverage is the company's use of debt. Leverage amplifies the variations in both earnings per share and return on equity. When we're looking at our first examples, we're going to ignore the effect of taxes. So what happens to earnings per share and the return on equity when we issue debt to retire shares of stock or buy back shares of stock? So let's look at an example. We have a company that is currently 100% equity funded. They have 400,000 shares of outstanding stock and a debt to equity ratio of 0. They are proposing to take out $4 million in debt to buy back $4 million of worth of stock, or half of their shares. They would reduce their shares outstanding by half, and they would change their debt to equity ratio to 1, where the debt to equity is equal. So what does that do to return on equity and earnings per share? So the company has set up different structure scenarios for their expected finances, what their finances might look like in a recession or worst case scenario, and what their finances would look like if they had a higher year than possible. So we're given different rates of the earnings before interest and taxes. So without any interest payments in part 1, because we have no debt issued, so we have no interest payments, our earnings before interest and taxes equals our net income, mainly because we're not considering the effect of taxes. So we can see what the earnings per share and the return on equity are under each method. However, if we leverage ourselves and take on $4 million worth of equity, then how the interest impacts our net income, and our return on equity, and our earnings per share. You can see that under the expected and the expansion, our earnings per share has increased, and the amount of our return on investment or equity has also increased. So the current return on equity ranges from 6.25% to 18.75%. And their proposed return on equity ranges from 2.5% to 27.5%. And then we have our variability in earnings per share. Under our current equity structure, our earnings per share ranges from $1.25 to $3.75. Under our proposed capital structure, the earnings per share ranges from 50 cents to $5.50. So the variability in both our return on equity and our earnings per share increases whenever our financial leverage is increased. We would want to look for a break-even area. So what is the point where our earnings per share is equal under both capital structures? So we solve for our earnings before interest and taxes, and what we find is that our break even is at $800,000. At an earnings before interest and taxes of $800,000, the earnings per share is $2 under either capital structure. At that point, it doesn't change our shareholder value if we take on the new capital structure, if that is what our net income profile looks like. Here's a graph of that break-even earnings before interest and taxes, or EBIT. We can see that we have the line with debt, so that's the purple line is with debt, and the blue line is with no debt. Any earnings before interest and taxes above $800,000, there is an advantage to our stockholders by taking on leverage. Any income below that break-even point, the leverage is detrimental to our stockholders. So understanding what our projected earnings are for the future can also help us to calculate whether it's beneficial to us to take on that leverage or not. So the conclusions from this example are that the effect of leverage, whether it is beneficial or not, depends on our EBIT, or earnings before interest and taxes. The higher our EBIT, the more beneficial leverage is to us. Under the expected scenario, leverage increases both our return on equity and our earnings per share. Our shareholders are exposed to more risk with more leverage. So then our return on equity and our earnings per share are more sensitive to changes in EBIT, so we have a little bit higher risk if we take on the leverage. We can also create what is called homemade leverage. So homemade leverage is where any shareholder wants to maintain the same amount of earnings regardless of whether a company changes their capital structure or not. So under this example, we have a stockholder who currently has $2,000 invested in the market. And so that's their 100% equity under their original capital structure. So if we want to make the homemade leverage, we would take out and create. So we would borrow an additional $2,000 and buy more shares of stock. Then that way, that would help us to get the payoffs under our proposed structure. We can create them with that personal borrowing. That's called homemade leverage. And if we create homemade leverage to replicate those payoffs, then whatever capital structure the company chooses becomes irrelevant to us as shareholders looking to keep our return the same. Now we're going to discuss capital structure theory. So this capital structure theory is created by a famous argument by two Nobel laureates, Franco Modigliani and Merton Miller. This is called the M&M proposition. So we have M&M proposition 1 and M&M proposition 2. So with M&M proposition 1, What this proposition states is that it is completely irrelevant how a firm chooses to arrange its finances. So this is the pie model. The value of the firm is determined by the cash flows to the firm and the risk of the firm's assets. Changing the value of the firm changes the risk of the cash flows. So we're going to look at this. So the pie model starts out with that total equity to finance equals total assets. So 100% of total assets equals 100% of firmed equity. Thus, the size of the pie doesn't depend on how it's sliced. The value of the firm doesn't change just because we change the percentage of debt to equity. The value of the firm stays exactly the same. M&M Proposition 2 says, although changing the capital of the structure of the firm doesn't change the firm's total value, it does make important changes to the firm's debt and equity. However, this tells us that the cost of equity depends on three things: the required rate of return on a firm's assets, the firm's cost of debt, and the firm's debt to equity ratio. The M&M Proposition 2 shows that as we take on debt, the required rate of return on equity grows because the risk to shareholders gets greater as we increase the amount of leverage of a firm. So we can break down the cost of equity into two components. The first being the required return on the firm's overall assets, and then the second on the nature of the firm's operating activities. So this comes down to what is called the difference between business risk and financial risk. So financial risk is increased by taking on debt financing to pay for our company. Now we're going to look at this capital structure theory under three cases. Case 1 assumes that there are no taxes and no bankruptcy costs. Case 2 assumes that we have corporate taxes but no personal taxes and no bankruptcy costs. And case 3 assumes that we have corporate taxes, no personal taxes, and bankruptcy costs. So when we look at the first example, this follows under propositions 1 and 2 of the M&M propositions. So proposition 1 is that the value of the firm is not affected by changes in the capital structure, and the cash flows of the firm do not change, therefore the value doesn't change. And proposition 2, the weighted average cost of capital of the firm is not affected by capital structure. So under case 1, the weighted average cost of capital would not change even if we change the capital structure. When we look at these examples in case 1, we have RA, which is the cost of the firm's business risk or the risk of the firm's assets. This is our return on assets that we're looking for. Then we have the cost of equity times our return on equity plus the debt value and the return on debt. So the RA minus RD, or the cost of assets minus the cost of debt, times debt divided by equity, or debt to equity ratio, shows us what the cost of the firm's actual financial risk is, or the additional return required by stockholders to compensate for the additional risk that leverage or debt adds to the shareholders. When we can see this graph, we can see that the change in capital structure weights is exactly offset by the change in the cost and equity. Our weighted average cost of capital stays exactly the same, but the return on equity, or the cost of equity, increases to take into account the added debt to shareholders. We'll explore the other two cases in the next video.